Welcome back. We're now in segment 7.6, and in this segment we'll be discussing about the means of finance. So in the previous segment we have discussed what is known as cost of the project. So there we discussed the various items that usually go into the arriving at the project cost, right? So we have discussed various items like land, building, plant and machinery, furniture and fixtures, and these are the tangible part. And we have discussed also other items like preliminary pre-operative expenses, contingencies, and margin for working capital. Okay, finally we arrive at what is known as the project cost. Okay, so how this project cost is going to be financed is known as the means of finance. Okay, means of finance is the how is the company proposing to meet this project cost. Okay, so broadly these are the four sources which a company usually resorts to finance the project cost. Okay, one is the equity, then it has the internal accruals, unsecured loans, and term loans from banks. Okay, we'll discuss each one of them in detail in this segment. So when it comes to equity, we discussed in an earlier chapter, that is in chapter 6. Okay, when we had an itemized discussion of balance sheet, there under the head of capital we discussed that capital or share capital, that is equity, is nothing but the borrower's funds. Okay, these are funds brought in by the promoters. Okay, so it's very important. We also discussed why it is very important for the bank to ensure that there's a margin, to ensure that the a borrower has a stake in the business. Okay, this is also something we discussed. So please, for this segment, please, for this topic, please refer back to this chapter 6 where we discuss capital. So please refresh this particular segment because these two are highly interlinked. Okay, so we also discussed the margin percentage is something that varies from bank to bank, but there should be some contribution. We can't have a case of a 0% margin, that is bank will not sanction the entire 100%. That's not going to happen. At least some portion should be coming in from the borrowers. Okay, so it's common for banks to stipulate this is the common margin, 25% on plant and machinery and 40 to 50% on land and civil works. Okay, I'm speaking of large projects. So for small projects like MSME, maybe this will come down maybe to around 25%. So again, this you have to check with your loan policy guidelines. So one of the important things that we discussed when we saw capital in chapter 6 was you should also always ensure that the envisaged margin was brought in. So especially when a loan was sanctioned in the last 1 or 2 years, you have to ensure that the whether the project was completed or not, right? If the project was completed then and the loan was completely availed, the entire promoter funds, there's the envisaged promoter's contribution should have been brought in. Okay, so this is something which we discussed earlier. So please refer back to this particular segment, capital under chapter 6. So suppose a loan is sanctioned in 2011 and comes to the bank for renewal of working capital limit or enhancement in 2012, right? Or it could be a standard term where you'll be conducting an annual review. So in either case, what you have to do, you have to ensure that the margin was brought in. How do you do that? You go back to the file, right? You go back to the last year's sanction and see what is the project cost and how was it proposed to be financed. So in the means of finance, you'll be having various items. Maybe there's some portion by equity, some by unsecured loan, some by term loan. So if the term loan was entirely dispersed, so in that case, the equity and the unsecured loans, the promoter's contribution should also have been brought in. That you have to check from the balance sheet. Okay. If in case the project is still under implementation, of course, proportionate equity has to be brought in. So if 50% of the loan was sanctioned, was dispersed till date, so 50% of the promoter's funds should have been brought in. Okay, this is something we should discuss in detail in chapter 6. Please refer back to the segment. We are not going to repeat that here. So one more item after one more part of the owner's funds is the internal accruals. These are profits written in the business. Okay, we discussed net worth is nothing but capital plus person surplus. Okay, minus intangible assets. Okay, leave that for this moment. Internal accruals is also one of the means by which companies finance the project cost. Okay, instead of bringing initial capital. There are a couple of points you have to understand when dealing with internal accruals. One, share capital is a one-way flow, right? Promoters bring in the capital and show it in increasing share capital, and they cannot withdraw capital so easily. Okay, there is a choice between capital and internal accruals. As a banker, you have to always prefer capital because it increases the owner's stake in the business. Okay. From a borrower's point of view, they will be always trying to not to bring in any additional capital. They want to manage the show with the existing capital structure. As far as possible, this is a point which we discussed under reserves and surplus in chapter 6. Okay. Again, please refer back to this segment, reserves and surplus in chapter 6. There we discuss a very important point that to the maximum possible extent, as a banker, always insist on fresh capital, fresh additional infusion of additional capital for term loan margin. Okay, so borrowers have to bring in their margin for any term loan. So that margin has to be brought in by additional capital as far as possible. Like there will be There will be instances when the borrower will be meeting that margin by the internal accruals, or part through capital and partly through internal accruals. But as far as possible, as a banker, try to ensure that the term loan margin is met by share capital, additional capital, right? Infusion of additional capital. The working capital margin, of course, we discussed this point also, right? So as the company grows in size, it will be requiring additional working capital. So for that working capital also, the company has to bring in additional margin. So that margin can be met out of retained earnings. That internal accruals you can use for working capital margin. So, but as far as possible for the term loan portion, always try to ensure that there is an additional infusion of capital. So one more thing, you have to be very careful about projected profitability figures. So whenever there is a scenario where the company is saying the project cost is going to be met out of various sources, and one of the sources is internal accruals. So whenever you have this sort of scenario, right, is the scenario clear? So whenever, say for example, the project cost is 80 crores, and the company is saying we'll meet for 30 from equity, 20 from internal accruals, and 30 bank term loan. Okay. So whenever internal accruals is a part of means of finance, whenever the company is saying we'll meet part of the project cost through internal accruals, so be very careful with the projected profitability figures. Okay. So for example, a company might approach you for a sanction of 8 crores, a loan out of the project cost of 10 crores, and the term loan, the 2 crores margin, the company might be saying we'll meet out of internal accruals. So the company is not saying we'll bring in any additional capital. It's saying we are generating enough profits, we'll meet that margin through the internal accruals. Projected financials anyway will show the sufficient profit, because these are just projected figures. So the company will show sufficient profits to justify this 2 crores will be generated. But what if that it is not generated? Okay, so be very careful to check the profitability in that case. Okay, so this is something which you discussed. Profitability, that is profit after tax by sales. This margin, the profitability margin, is something you have to always check, and especially compare it with similar units in the industry. Okay, say in the past 5 years the company has made a profit margin of 46%, whereas in the projected profitability projections is showing a margin of 10%. This is to be questioned. Okay, so the company is basically projecting a higher profit figure, which is not in line with the industry trend, nor in line with the past performance. Okay, what basically company is saying is projecting a higher profitability figure just to arrive at just to show a higher profits in the coming years, and saying we'll meet the project cost part, our margin out of this internal accrual. So you're in such scenario, you have to always check this projected profitability figures and ensure this is margin, this projected margin is either in line with the past performance or in line with the industry trend. I'm not saying reject it straight away. So if a company is making a profit margin of 5% in the last 3-4 years and suddenly showing a margin of say 10%, I'm not saying you decline it straight away. I'm not saying that. This can still achieve. This can still be happening. How? Maybe the company has started maybe this proposed expansion project will remove certain bottlenecks, and therefore the profitability may be increased, or the company has started actually a new product for which the margin is higher than the existing product. So there could be a number of reasons where this is possible. I'm not saying you reject it straight away, but inquire, right? Inquire what is the basis for this higher projected profit margin. Okay. So one more point you have to keep in mind when the company is proposing to use internal accruals for project costs for meeting the margin for the project cost, is it should be ensured that the NWC position is comfortable. We didn't come to NWC still. We'll be discussing this in the chapter of working capital. That is in the next chapter. But you have to understand. But just remember that if profits are retained in the business, NWC will be approved. Okay. There should always be sufficient NWC in the system. So the company, if it uses retained earnings for some fixed assets or other long-term purposes, NWC will not improve. So the company has to retain that profit in the business, and those funds should go to the working capital cycle. Okay, this we'll discuss in detail in the next chapter, but just a point to keep in mind. So one more means of finance could be unsecured loans. This also we discussed in earlier chapter, in chapter 6, where we said that usually this is nothing but capital in disguise. This also we discussed, right? So companies, the promoters usually will be reluctant to bring in their entire contribution in the form of capital. They will show some part of it in the unsecured loans. So unsecured loans are loans which are not backed by any security, right? We make a distinction between secured loans and unsecured loans. Secured loans are usually these term loans from banks because they're backed by some tangible security. Unsecured loans are loans that are not backed by any security. They are usually brought in from very close persons of the promoters, like friends and relatives, okay, or group companies, subsidiary companies. So this is again, from a banker's point of view, is always advantageous if the company brings it in margin in the form of equity and increases the owner's stake. But stipulate a condition and be very careful in monitoring that these unsecured loans are not withdrawn during the loan till the loan is closed. Okay, so this has to be stipulated as a condition. Also, not just stipulation, but also to ensure that it's implemented in the coming a couple of years. You have to check the balance sheet and ensure that these unsecured loans are not withdrawn. Okay. So the other means of finance is term loans from bank. That anyway is the discussion of this chapter. One point with regard to promoters' contribution you have to keep in mind is the time at which it is brought could be different. Okay. So when we're saying that a project of 10 crores is being financed by a equity of 3 crores and debt of 10, so equity is 3 crores. This 10 crores is being financed by equity of 3 crores and term loan of 7 crores. Okay. So when should the promoters bring in this 3 crores is one of the questions. Okay. So should he bring in this entire 3 crores initially upfront without the bank disbursing even a single rupee? Right. First he brings this 3 crores entirely, and then the bank disbursement starts of the 7 crores, or should the bank release the 7 crores first and then he brings in the margin, right? Or both should do it proportionately. That is, the disbursement is 1 crore, say for example 1 crore. So this ratio is 30% margin. Okay, 30% margin. So if the initial disbursement, phase wise disbursement, the first disbursement is 1 crore, then the promoter will bring in 30 lakhs and the bank will debit the term loan by 70 lakhs. It will release 70 lakhs only. Okay, and put together it will issue a DD for 1 lakh or for 1 crore. Okay, to the machinery supplier. So proportionate margin is always ensured. So which is a correct way to ensure. Okay. Anyway, common sense will tell us that this is not acceptable. Bank cannot release 7 crores first of all and then say you bring in your margin. That's not anyway acceptable. Out of these two, well, definitely this is advantageous for the banker. So this means the promoter's funds are entirely committed. So if you say the borrower has to bring in the entire margin before bank releasing its portion, that is a very safe option for a bank. But then on a practical plane, maybe this is more common. Okay, proportional disbursement is usually ensured. Actually, you have to refer to RBI master circular on loans and advances. These master circulars are very important for banking industry. These circulars are updated every year, usually around July. So please check this. So make it a habit to keep checking RBI website for any new circulars. Okay, master circulars, and the existing master circulars are updated every year. Please be up to date with the latest circulars. So as per RBI master circular on loans and advances, so what they say is banks usually adopt one of the following methodologies. One, the promoters bring in their contribution upfront. That is the first case we discussed. Or second, the promoters bring in certain percentage, say 40 to 50% upfront, and balance is brought in stages. Or proportionate disbursement. That's the third option which we discussed. So RBI feels that this third option is actually a case where there is a greater equity funding risk. Okay, so RBI advises banks to have a clear policy regarding the debt equity ratio and ensure that the infusion should be such that the stipulated level of debt equity ratio is maintained at all times. So please see what is the preferred mode in your particular bank, how they are doing. In risky cases, it's always better to ensure that the promoter brings the entire margin. They might object to it, so at least you can say, please bring in at least 50% of your contribution. Please bring in 1.5 crores upfront, and we'll disperse proportionately. So we'll then start the disbursement of 7 crores, and the balance 1.5 crores you bring in proportionately, right? So that is usually so that is one thing you can consider. It depends from case to case. Okay, we cannot have a hard rule, right? It's always better for a bank to ensure that the borrowers bring in the 100% margin upfront. But since this is not practical, since no company will accept this, right? So what we say, at least, so what companies will say, let us go hand in hand, let us go proportionately. If the company wants 1 crore machinery, to purchase 1 crore machinery, it will bring in margin of 30 lakhs and bank will disperse 70 lakhs. So proportionately, that's what the company will bargain for. But then as a banker, then you might say, this is not acceptable to us, since we prefer this, but since this is not acceptable to you, maybe you bring in some 30% or 40% or 50% upfront of your margin, of your entire margin. That is, if 3 crores is a margin, at least bring 1 crore to 1.5 crores, start the works, and then we'll come in, and then further disbursements can be made proportionate to your margin. Okay, so there are things you can bargain for. It depends from case to case on the riskiness of the project, the nature of the promoters, whether they are willing to commit their stake in the business. So a variety of factors influence the bank's decision. Okay. So with this we come to the end of the segment. In the next segment, that is 7.7, we'll be discussing about term loan eligibility. Okay. See you then.